Hello, my name is Aaron Dubnikoff, and I'm Managing Director for Sales for Arrow Capital Management, and I cover advisor teams in Manitoba and Saskatchewan. So I'm on the call today from Winnipeg. Joining me today is my associate Colin in Toronto to assist with technology, as well as a number of my Arrow Capital colleagues, and of course, advisors and associates from coast to coast in Canada. Our special guest and presenter today is Ted Whitehead, the Portfolio Manager of the Exemplar Growth and Income Fund. We last had an opportunity to hear from Ted when we hosted a webinar on January 19th. At that time, we were told to expect a very interesting year ahead. So I think that today's webinar is timely, as we have indeed continued to experience volatility in the market and ever-changing media narratives. During our time together today, Ted will provide us with an overview and an update on the strategy, and will also share his thoughts on how the fund has been positioned so far this year and what to expect over the next 2 quarters. Ted will also highlight what macro indicators he is finding important to monitor, as they may impact his asset allocation decisions going forward. At the end of the presentation, we will have time for questions, so please feel free to type your questions into the Q&A box at the bottom of your screen, and we will get to as many as we can in our allotted time. So with that, I'm happy to turn the meeting over to Ted Whitehead.
Thanks a lot, Aaron. So we're going to start with the investment process recap, talk about the first 4 months of the year, and then our forecast. But before we move on from this slide, I thought I'd talk a little bit about the tightening, the rates being raised by Jay Powell. And the importance of this slide here is normally a rate hiking cycle begins in a quad 2 and extends into quad 3. And then by the time you hit a quad 4, where growth is slowing down and inflation is slowing down, that's when you should be raising rates. And we are in a quad 4 and have been since the beginning of the year. And it's usually when the Fed raises rates in a quad 4, that's when things tend to break. So this is a quote by Ray Dalio, and for all investors out there, everything is possible, but what you have to do is weigh the probabilities. And with our quad system, that's exactly what we're trying to do, is what's the probability of certain things occurring? Nothing is 100%, nothing is a silver bullet, but we're trying to put the odds in our favor to forecast the markets. Yeah. So I thought we'd go over this slide again, and it highlights the 4 different quads. And quad 1 is when growth begins to accelerate and inflation is at a lower level or is still declining. Then as the economy expands, you go into a quad 2 where GDP and inflation go up together. And in quad 3 is when inflation is lagging. It's still high, still going up while GDP rolls over. And lastly, quad 4 is what we believe when GDP is going down and inflation is going down. So in quads 1 and 2, you essentially want to be overweight equities and the credit market. And in quads 3 and 4, overweight fixed income and generally gold as well. Here we break down the asset allocation a little more, and it's a little more thorough, but not everything works. Like a quad 3 will not always have the same things working or not working each quad 3, because you get different variations of a quad 3 or a quad 4 in different market cycles. But if you look at the quad 4 and the first 4 months of the year, it has fixed income, gold, and the US dollar is where you want to be. And that's where we've had our overweights. And fixed income was up about 3.8%, and gold up about 9.7%. And the US dollar had a lot of volatility, and it ended up being flat. So is it different this time? I would say it always is a little bit different. So it sort of is. This is our performance versus the benchmark or the TSX and S&P. And you can see in the first 6 weeks of the year, the market took off. And the market in that time frame, it was the best start of the year since 1987. And I guess in my mind, alarm bells go off when I hear something like that. Also because of the background of what's going on in the marketplace, from the zero-day trading, expiry options, the CTAs or the commodity trading advisors, high frequency, the vol control, a lot of mechanical investing in the market. And again, if you think back to 1987, the new fad back then was portfolio insurance. And I was in a seat in October of 1987, and that portfolio insurance blew up. And I'm not saying that this the new technology is going to go that way, but I am concerned. Anyways, so the market in early March experienced a drawdown caused by a few banks going bankrupt in the US and Credit Suisse going under in Europe. And that was a period when we did well. So we've highlighted that this year we've been fairly negative equities and invested in, as I mentioned before, more bonds and gold. And during that period, the week of early March to March 17th, on a daily basis, we were hanging in pretty well as the markets were going down. And even on the weeks, like for March 10th, the fund was up 1.16%, the TSX down 392, and the S&P down 455. And in March 17, we were up 47, TSX down 196, and the S&P was up 143. Now, I understand the 4 months was not just 2 weeks, but this gets back to that first slide of the tightening in a quad 4 usually breaks something. And very quickly, the Fed responded and this seemed to disappear. Now, are the banks all well and good now? Maybe, but I think another thing to keep in mind on that front is the lending standards have tightened again. They came out in April, and the indication for the first quarter that lending standards have tightened even more from what was reported in January. So I think the balance sheets of not just those banks, but that went under, but other banks in the US are strained. There was a report put out by the New York Fed that said 24 other banks are in the same position as they are, the banks that went under. Not saying those banks will go bankrupt, but there are some residual issues with the banking system. So on this slide, we're just highlighting what did well. It was NASDAQ. Well, ever since, again, when mid-March, the AI became the buzzword, and anything related to AI has gone up. But if you look further down, like the Russell 2000 is fairly flat, and the equal weight up small as well. So it has not been a broad-based advance. And maybe you could say the same thing about last year. There was just one area of the market that did well, which was energy. And again, here you have one area of the market that's doing well, and that's AI or some of the tech names. So it wasn't the best of times for us. We were up 74 beeps in those 4 months. Equities, we didn't really add any value. we're trying to be defensive, and the cost of insurance is high, and that it did pay off. Hopefully, we lowered the volatility in your portfolio on the weeks that the market were down. Bonds did fairly well. Commodities, our gold exposure helped, and the foreign exchange was very volatile, and that ended up costing us about 80 basis points. So then, quick slides on the equal weighted S&P. Actually, as of yesterday, it's negative 17 basis points on the year. So what we're showing there was just up about 2 basis points. And you can see at the end of January, ever since that point in time, the market has been coming on. So maybe we can speak to that a bit. Is the data, the economic data that came out in January was better than expected, and then rolled over and became more of a quad 4 like we expected in February, March, and April. And what happened in January is we had poor weather around Christmas, delayed some shopping. I know many friends that do all their shopping on Christmas Eve, and we had snowstorms up here and in the northern US. And we had great weather in January, and people spent the money in January. Anyways, next slide. This is the Russell 2000. Basically, it's negative now, just less than 1%. Again, it had the big run up in the early part of the year. And at that point in time, it was just up small. And lastly, the strong bull is the triple Qs, or the NASDAQ 100. It's currently up around 23%, being led by about 10 stocks. And on the breakdown of the sectors, you can see communications, infotech, consumer discretionary, and it's Google, Meta, Microsoft, Tesla, Amazon. And beyond that, the defensive stocks where we were hiding in, such as staples, healthcare, utilities, energy, really didn't perform. And most, I'd say 100% of our energy is really Canadian energy, with the dividend yields in the Canadian energy stocks are quite high. And half of our names are the pipelines. But even in Canada, the defensives were not really the place to be. Shopify alone was up 70%. And that's where the performance came from. So again, if you wanted to see the numbers, that's how the big five performed. The new buzzword is AI. As someone said around here, it sounds like the .com bubble. Today, all you have to say is AI and your stock goes up. Back in 99, 2000, all you had to say is you're a .com, petvalue.com, and the stock would go up 100%. So is it a fad? Is it for real? I saw a report yesterday from, I'm not sure, stating that, I think it was Goldman, that margins could improve by 400 basis points if everyone used AI. So you're getting these wild claims, because when he talks about that, he's talking about a 10-year period. So I think you're getting a lot of front-end loaded performance, and I wouldn't chase these stocks here. So looking at the different indicators that come out every month, there's 30 different economic data, and you can see all the way back it goes back on the very left to April 2021, quite green, and this is when we were in quad 2s. And in 2021, the fund was up over 17%. And then as you move over to the right-hand side, the chart becomes more red, and more red the first part of this year. And those indicate that we're in a quad 4. And so the data is telling us to be more defensive, and that's what we've been doing. So what happened when we talked on the webinar in January? The data suggested that we would have a recession. Like I mentioned before, Good weather came in January and was delayed from December. So the data was a big surprise, and stocks rallied hard in the first part of the year and then have slowly gone down, as you can see by the Russell 2000 and the equal weighted S&P 500. I guess in summary, like maybe it's a little lame, but we were ready for rain, and instead we got a mix of sun and clouds. The first 4 months, the momentum came from the MAGMA stocks, and again, when the banks had their problem in mid-March, that's really when the AI story took off. And if you look at the NASDAQ from that point on, it's like a straight up. So what do we think about the next part of the year, the last 8 months? I think a 10% plus correction is possible. I also think a range-bound market is possible. By range-bound, I think anywhere between 3,800 and 4,200, maybe 4,300. And that's because as the data moves on in the second half of the year, it becomes more right around the X and Y axis, where it's hard to decipher whether it'll be quad 1, 2, 3, or 4. We don't think it'll be a quad 2, which is accelerating growth with accelerating inflation. So I think the odds favor either a shallow quad 4, or it still could be a deep quad 4, or maybe shallow stagflation. And then the next part is really the Fed is the big unknown, because they play both the arsonist and the fireman. And lastly, we'll talk about employment, the work from home, the debt ceiling, and bonds, oil, gold, and cash. So I hear a lot of people say everyone's bearish. And I've even heard anecdotal evidence that people are bearish, but their positioning is neutral to bullish. And that's what this slide shows, is that the orange people are still 60 to 65% equity, even though they're fairly negative, comparable to 2008 or 2011. So again, whether you use the quads or earnings, you can see in the first 2 quarters of the year, earnings are negative. They're going down sequentially in the S&P, but they're down dramatically in Toronto. And then things start to inflect positively in the back half of the year. So we are a little more positive on the back half of the year. But I would have a caveat to that, is I think you would have to see some sort of correction to get good value for your money, to step in and buy. So maybe these quads don't work from right on July 1st or September 1st. Earnings start to get reported late July. So we'll probably know more by the end of July how things are playing out on the earnings front. Have we seen a bottom? Well, when I wrote this, I thought, everyone bears their scars. And, if you talk to people about Germany, the big scar they carry is the Weimar Republic in the 20s. So they're always afraid of inflation, because it was inflation that destroyed the economy in Germany in the 20s. And in the US, the scar that they bear is deflation, because that's what everyone remembers from the dirty 30s or the 30s, the Depression. But even people wear scars. And so what I recall in 2008 is the S&P did have a rally. Now, it's a smaller window than what we're experiencing now, but the market went up about 15% in the spring. And this was right after Bear Stearns was sold for $2 a share. And the VIX went from low 30s to just above 16. And as you can see at the bottom number, just 6 months later, the market was down almost 50%. I'm not saying that's going to happen. I'm just saying the setup is somewhat similar. We've had a decent rally, whether you consider the bottom in June of last year or October. We've had higher highs. We're up close to 20%. The VIX last June was 34, and at the end of April, we were around 15. So when you have a VIX that's done a move like that, generally it means a lot of complacency. And I guess that's what I worry about. And maybe it's being an old timer in these markets, but I've seen this sort of thing happen before. And like I said at the beginning about the 1987 and the different and how we had portfolio insurance back then, things can come off the rails pretty quickly. And I don't really have anything in mind that can submarine the market or make the market go down 25+%. But I'm willing to be cautious or patient until the earnings start inflecting up again, which is in the back half of the year. I'm sure people are frustrated, like I am, that it's not really people don't really see the risk in the market at the moment. But you've had the interest rates go up 500 basis points in a year. You are seeing lending standards tighten. You've seen the 15th and 16th largest banks go under. You've seen a pinnacle bank, a global bank, go under, Credit Suisse. I just think more caution is warranted, but that's just one person's view. So if we look at the forecast for GDP, it's going to come down and then sort of flatline for the balance of the year. But after the first quarter or after the second quarter, it is going to flip up, and it is a questionable whether it goes from 0.41 to maybe it does go up to 0.8, and maybe the 0.77 gets revised to 0.9. Maybe things do improve, but at the same time, they could over time begin to look worse. So again, the numbers are not all that compelling to take on a lot of risk. And on the inflation front, it's kind of the same. Things are coming down. They're coming down fast. We think inflation will get down below 4% and stay sticky there. Some forecasters have inflation getting down to 2% by the end of the year or first quarter of next year. That's a little far out at the moment for us next year, but we still have inflation staying up in the 3 to 4% range, as some of the things that are lagging are wages, and they're expected to continue to be high. The latest report from, I think, the Atlanta Fed had low-income people getting wage increases of 7%, and people switching jobs getting wage increases of 13%. Even in Canada, they're getting around 4%. So on a graph basis, you can see when we get out of, the second quarter isn't on the page, it's way off to the left. When we get past into the back half of this year, it gets more around, as I say, the X and Y axis. So it can be more variable, or that what you'll get is some data in each of the different quads. It'll be a mix of inflation, disinflation, growth, and not so much growth. Next slide. So for the moment, we are in this box of deflation, disinflation. It's really disinflation. So we are partially invested. We're overweight bonds, underweight equities. Maybe we've been too underweight equities. I think we did pretty well in the mid part of March, but since then, equities have come back strong, especially in NASDAQ land, and we really haven't participated there. Next slide. So again, on the quad basis, you can see globally, a lot of countries will be coming out of this quad 4 scenario and going into quad 1 or quad 2. Again, it doesn't happen like July 1st. It's more dynamic and fluid as the data comes in. But over the July to September period, things should start to improve. So when we talk about the Fed being the arsonist and the fireman, there's an old saying that old markets don't die of old age. They get murdered by the Fed. And essentially, I think that's what's happened. Now, if you go all the way over to the left, you can get the tail end of 2018 as they're raising rates. And again, that was a quad 4 where the Fed was raising rates. And in December, we had a wipeout, the Christmas massacre. And again, we were positioned for that. And at the end of the year, we were able to be up 3% in a year where most people were down. And again, so as the Fed's been raising rates, the beginning of this year, we've been getting more negative that something negative on the equity market would happen. We did get it. It didn't last very long, but maybe there's more to come. And as far as the firemen, you can see, you've probably seen this chart before. This is the Fed balance sheet. When the Fed balance sheet goes up, the market tends to follow. So you had the big spike up in 2020 when COVID hit, and then it didn't really peak until later in 2022. And that's when the Fed started its quantitative tightening. And so they're making some progress there. And then in March, the banks went under. They opened the discount window and offered loans to the other banks. And so Fed balance sheet spiked up. And lo and behold, that's what the market went up as well. But then since April, it's been coming down again. So it could be getting ripe for another event. On the labor front, Canada has about a 65% participation. It used to be around 68%. I'm not 100% sure why it's come down as much as it has. But if we flip to the next slide, which is the US, it has not bounced back as much. And the participation rate is around 62%. And what I understand there is 3 million people, 1.5 are on disability, and another 1.5 million are suffering from long COVID. And if you added that back to the participation, you would get close to 65%. And so what happened is they've made disability easier to obtain in the US. And I think what part of this debt ceiling is, they're trying to get people to work to receive some benefits if they're able-bodied and have no dependents. On the office vacancy rate, it's up near 19%. And I guess pre-COVID, it was under 17%. In New York, it's over 22%, 22.4%. I think this is a new issue that we have to deal with is there is a crowd that's not going back to the office. And so the vacancy rates is gone up. And again, getting back to the banks who have lent money on office towers or the owners of these office towers, whether it's insurance companies or pension plans or REITs, the value of these office buildings have come down for two reasons. One, the cap rate has gone up because interest rates have gone up, but also the cash flows have come down because vacancy rates are higher. So this could be something, a bigger issue with the banks, but it won't be, a one day event. It'll be a continue, and we'll maybe see more when banks report in the summer. On the Treasury bond, when I put this together, it was looking like the 20-year bond was ready and poised to break out. It's been hovering between 100 and 105. I would wait for it to break above that red bar, which is more around 109, and then probably has room to go to 120. It currently hasn't sort of resolved going one way or the other at the moment. So it's too early to call that. And maybe part of the reason that the bonds are kind of unsettled is whether it's the debt ceiling or the fact that inflation remains stubborn or sticky. On the gold chart, that's not really a very good picture of a cup and handle, but that's what I was trying to draw. Since then, gold has come off. We're sitting around 1950-ish. I still think there's room for gold to go higher, but it will be capped by that green line, which is around 2075. But once it breaks through there, it's probably got 10 to 20% of upside. On oil, I drew a line which sort of is the median. It's just under $70. I think it's around 69.25 or something like that. That seems to be the equilibrium. I think the Saudi Arabians are trying to keep oil prices higher, so they've cut production, but they've also announced they want to sell a portion of Saudi Aramco. So I think there's a reason for them to try to get prices higher. And people may tell you that it's demand that the reason why oil prices have come off, but the way our understanding is it's really supply, ongoing supply from Russia, Iran, and even Venezuela. So you hear about a lot of money being on the sidelines and in money market funds. Well, the arrow in the round circle, that's when the Fed started to raise rates. And you can see as rates continue to go up, money markets continue to grow in size. And with rates around 5%, people have moved money to money market funds over time. I don't think it doesn't mean that there's not money on the sidelines, but I guess the 5% rate is compelling that people are not stepping into equities. So lastly, on the debt ceiling, this was put out by Goldman Sachs, how certain asset classes did in 2011 into the run up to the debt ceiling. And three of the areas that were weighted, gold, bonds, and Canadian and the US dollar all did well in that period of time. Gold went up over 11%. The Canadian dollar went down 4%, so the US dollar went up 4% versus Canada. The bond yields went down, I think 10 years, 86 basis points. So the bond prices went up, and equities or risk assets went down. Russell went down 21%, S&P 500 16. We haven't experienced that this time. And again, getting back to the arsonists and the firemen, the Fed is when the Fed came and bailed out the banks in March. The perception of risk disappeared, and that's when the VIX began to go down below 20. And again, it's the Fed put that they have your back. It's basically whatever happens, you'll get saved by the Fed. And I don't think that's going to be the case, or they have the ammo to do what they did in 2020 if something else gets more drastic. So anyways, we haven't really experienced these moves going into the debt ceiling like we did in 2011. So the summarize, I think the breadth is deteriorating, and you see that in the S&P equal weight now being down on the year, the Russell 2000 now being down on the year, Usually that's a bad sign. It reminds me very much of September 2018. Like I say, back then that was a quad 4. Again, it was the nifty NASDAQ was rising, and then with a narrower breadth, and then things rolled over in October, November, December. The credit event has occurred. It seems to have been put out by the Fed, but I think there are still uncertainties with regards to real estate, and just whether there are other banks in a similar situation to the ones that went bankrupt. But the Fed is trying to avoid an accident. They don't have an intention of putting the economy into a recession, but I think 500 basis points is a new frontier in 1 year. And so there is risk of something else going wrong. So as far as possible outcomes, I think it's still a high risk of recession. We could get slow growth, or we could get stagflation, slow growth with inflation ticking back up. I think the missing ingredient why people are not as bearish or negative on the market is unemployment hasn't creeped up yet. And a recession becomes more probable if that happens. I guess my only answer to that is a lot of the data we see, whether it's delinquency rates on credit cards, are at 2008 levels, and you have full employment. What happens when you get employment going up 0.5% or 1%? Harley-Davidson mentioned on their call that their margins were impacted by their inability to repossess the amount of motorcycles they've sold where payments had stopped. They don't have enough repo guys to go get them. So the anecdotes are out there that the consumer is suffering. Again, whether it's a lot of people in the lower income are working 2 jobs. And that's just to make ends meet. So anyways, we remain cautious. We are open-minded to getting more aggressive into equities as the earnings turn around in the back half of the year or reaccelerate. It's not even about absolute being better. It's just reaccelerating the rate of change. Oh, well, in the last slide we've seen before. It's really, you need to survive, you need to adapt. And I would say our strategy or our process is we do try to adapt to different environments. We see the environment, I guess, different than the players that are buying the NASDAQ right now. But that's, like I say, if you look at the broad market in the US, it's down. Not that helps anybody. Everybody wants to make money, but the broader markets are negative on the year. So on that, I can take questions. Oh, we can't hear you.
How about now?
I can hear you.
Okay, perfect. So I do have a couple questions here, Ted. So if the equity drawdown that you're expecting happens, what sectors do you believe will lead the new rally afterwards?
That's good. That's a good question. So it all depends on how it kind of plays out with those different quads. But in general, I think it will be technology. And it's, I just think at the moment they're very expensive. And it's very narrow focus as to what will work. Like, for example, Cisco reported yesterday, and the guide forward was not all that positive. In the aftermarket, it was down 4%. But today, it was up like 10 cents when I came in here. So let's say flat on the day. I think it could be broad-based in the technology sector that you want to be. I think there's a lot of people out there that think commodities will be the next like super cycle. I'm not really in that camp. I think they'll be market performers, maybe a little bit above, because commodities will become more scarce as time goes on. But I think we're right in the back half, and we have more or less slow growth, and I think maybe that could be the prospect for the next 5 years is growth rates of between 1% and 2%. And one of the things we never really talk about, but on the demographic side, if you look forward, there's more people becoming older than joining the workforce. And I think that will have an impact on growth and also where different sectors will do well. So travel and leisure is probably an area that will benefit as more people are retired. So I don't think it's going to change. Like in the 70s, you would have said it was steel, autos, and industrials. But I think the new industrials in our day and age is semiconductors.
Okay, I've got one on oil and gas. Just asking on oil and gas, the year-to-date sell-off, is it mostly overdone due to recession fear, or is there fundamental weakness in the sector?
So we don't really see it as a demand problem or like a supply. And so Saudi Arabia drives the bus there, and I think they have pretty good connections with Iran and Russia now. And just the other day, Russia said they're going to curtail production by 500,000 barrels a day as well. So I think below that level of $69, $68, I think you should look to buy. And above, say, $85 probably is where you would sell oil. So I think the advantage of the Canadian oil stocks is they've been using a lot of cash to pay down debt. So the debt levels are not what they used to be. So they can buy back stocks and they can crank up dividends. And that's what they've been doing. So like, if you like natural gas, you can buy a company like ARC that pays 4%.
Okay. Another one here. Does a potential recession kill stagflation going forward?
A potential recession, the advantage of probably having a recession is it would kill inflation. Yes. So then when we would recover out of that, hopefully we get more of a Goldilocks, which is growth accelerating without inflation.
All right. Another one here. What changes would you be willing to make to the portfolio if unemployment rate starts to tick up? I think you mentioned that it already was up a little bit, but if it continues to go up significantly in the coming months, are there any changes to the portfolio that you would make?
We would buy more bonds. Because what should happen is, as people are getting laid off, their ability to demand higher wages will dissipate.
Okay, another one back to energy. This one I think you touched on already, but maybe just a little more clarity. The attendee is asking, in quad 4 has energy as the worst equity sector. I believe it's still high exposure in the fund. Why would that be?
Yeah, so half of our energy is pipelines such as Enbridge, Keyera, Pembina. And although they're in the energy sector, I view them more like utilities. Whether that's correct or incorrect, that's the way I view them. I mean, my utility bill is with Enbridge. And then we do own a few We own CNQ, which I think is the Cadillac of energy. I think you always want to be diversified in your sectors. And energy also, like a producer like CNQ, and we also own Suncor, is a bit of a hedge against inflation. And then one of the last name we have in that energy is Cameco. And we think that's part of the revival of uranium or nuclear power.
Okay, I've got another question about our positioning on gold. Maybe just clarification on what the weighting is in the portfolio, but the question is how the fund, they're asking how is the fund position on gold, which saw a huge sell-off in recent days. Is this risk on all over again? Is the banking crisis and debt ceiling no longer any issue to the market? And I know you did touch on those topics, but perhaps just a little bit more color on some of those.
Yeah, so we had around 7% in gold, the GLD, we're down to about 5.5%. We sold that in the 2050 range. Like I said, it's now around 1950. We're probably going to look to add back. We used to have around 4% in gold stocks. That's around 3%. So we do try to trade the ranges, but we do view it as a core position. Typically, gold does well in a decelerating growth environment, and it does well when bonds tend to do well. So unfortunately, a lot of these assets either all move one way or the other. So I guess to answer the question, if gold really starts to break down and, the indexes start taking out higher highs, or really it's more, if the Russell 2000 starts to participate, that's a real sign of the market starting to bottom out. So in a quad one is usually when that would be the first, when the market recovers. And that's when you really want to be overweight small caps. And like I say, I think the Russell at the end of, the peak this year was up 8%, and now it's down almost 1%. So I think that is like some things are really playing out as the quad four, like the Russell, the broad market is playing out that way. The gold has been up, the bonds have been up. It's really that this technology space and fairly confined as I don't know if I think this is a word, but it's befuddled us. Like it's do you know in the tech sector earnings were down like 17% for the sector as a whole. And I know people will say, well, the big five or whatever, they all beat. And that's true. But if we are in a recession or a market slowdown, they still need to sell their product to someone. And if everyone is reining in their horns, it's got to impact their earnings as well. And again, if you look at Apple, it's really, I guess it works. They don't really grow revenue. They just buy back stock and issue more debt.
Speaking of debt, there's a couple more questions here. I'll just combine a few because they're asking specifically about the bond allocation in the portfolio. I guess just a comment on the positioning as far as quality and duration, and then are you looking at increasing more high yield bonds, or are you sticking mostly with investment grade?
Yeah. So again, the other in quads 3 and 4, generally credit spreads go up, and I have that here somewhere, and that's exactly what's happened. Is investment grade at the end of December, the spread on 10 years was 187, and now they're 231. Basically, a recession, you usually see spreads widen out beyond 250. And on triple C's or high yield, it's 508 at the end of December, and it's 518 now, or maybe, maybe there's a couple days old. So that is playing out as well. Like credit spreads are widening out. So a lot of the things are, I guess, playing out. The volatility in the dollar really caught us, which cost us 80 beeps. We still think that there's risk in the Canadian dollar because the Bank of Canada has stopped raising rates. And since that time, the Fed has already raised rates 2 more times. I think the real estate in Canada is going to prevent Bank of Canada from raising rates further. They had some comments out today saying households are financially stressed. So I guess to answer your question on, we are either Government of Canada bonds or US bonds. Our US bonds are all 10-year, and our Government of Canada are 2 years or less.
Okay. Have you got time for one final question?
Sure.
Okay, this one is asking if it's an alternative mandate, which does both long and short. And if so, how is the short book positioned? Is it for generating alpha or more for defensive purposes?
So normally it's for defensive purposes, but I would say we got aggressive this year in trying to make money in the down, which paid, it worked. It worked in those 2 weeks in March. But I'd say maybe we've been too much trying to make money in the down. And so we're probably going to tail that back, especially as we get into the back half of the year where it'll be more for defensive purposes. And typically it's indices. And I think of late, what hasn't helped is we've been short the US market and long Canada. And so like a day like yesterday or the day before, Canada was down 1.4%. And the US markets were mildly down. And the reason we've done that is the volatility is less in Canada.
Okay, that's it for the questions that I have. So maybe I'll just take a moment and wrap up. Thank you very much, Ted, and to all of you who are on the call today. We truly appreciate your time. So a couple of key takeaways. The fund is very cautiously positioned with weightings in asset classes such as gold, bonds, and the US dollar that typically perform well in risk-off environments. The fund offers low correlation to other balanced funds and equity markets. The Exemplar Growth and Income Fund has been a top of class performer and has proven to be able to successfully navigate volatile and difficult markets. And if you are looking for a low volatility and low correlation idea, the fund also intends to grow capital in all market environments. We would strongly encourage you to consider the expertise that Ted and the Arrow investment team can provide for you. For those of you who are already supporters of Arrow Capital and the Exemplar Growth and Income Fund, we certainly appreciate that support. Should you have any other questions beyond what we covered in today's call, please reach out to your local Arrow Capital representative. So this concludes today's call. We thank you again for your time today. We hope that you enjoy the rest of the week and also enjoy the long weekend.